Let's talk about something that confuses a lot of people: taxes. Even Albert Einstein once admitted that understanding income tax is one of the hardest things in the world. And if a genius like him struggled with it, it's no surprise that most of us do too. Now here's the thing: wealthy people don't just accept high taxes as a given. They have top-tier accountants and tax strategists who help them legally reduce what they owe. And over the past decade, we've learned a lot about how they do it. This knowledge has helped our businesses grow faster and build wealth more efficiently. So, grab a notebook because some of these insights might come in handy one day. Here are 18 legal tax secrets the rich use to pay less and stay wealthy. 1. Move to a place with low or no taxes. Most people don't realize how much where you live affects how much you pay in taxes, but the wealthy have been using this trick for years. Think about places like Dubai, Monaco, the Cayman Islands, or the Bahamas. These countries don't charge income tax. That means if you live there, you keep every dollar you earn. Sounds great, right? But here's the catch: living in these places isn't cheap. Monaco, for example, has sky-high rent and luxury prices everywhere. But for someone earning millions, the amount they save on taxes often makes up for the higher cost of living. Now, this doesn't mean packing your bags overnight, but if taxes are eating up a big chunk of your income, running the numbers on a move could be worth it. Sometimes a change in location can completely change your financial future. 2. Move your money overseas. Big companies like Facebook, Google, and Apple don't just accept high taxes, they find legal ways to reduce them. One of their favorite strategies? Shifting money to countries with lower tax rates. Here's how it works. These companies set up businesses in places like Ireland, which has very low corporate taxes. Instead of keeping all their profits in the US, they pay their Irish company for things like licensing fees or services. This counts as a business expense, which reduces their taxable income in the US. Meanwhile, the money lands in Ireland, where the tax rate can be as low as 1%. Now, you might not be running a billion-dollar tech company, but the same idea can apply on a smaller scale. If you live in a low-tax country, you could set up a local business there and charge your US-based business for services. This helps shift profits to a place where taxes are lower, keeping more money in your pocket. It's no secret that big corporations would rather pay a fine than pay full taxes. And when you really think about it, the system is kind of ironic. A fine is what you pay for doing something wrong. A tax is what you pay for doing something right. The key is understanding how the game works, because the people who do end up keeping a lot more of their money. 3. Reinvest everything you can. Here's a secret the rich know that most people don't. They don't let their cash just sit around. They make it work for them. If you've ever wondered how wealthy people seem to always be growing their money, here's the key: reinvested profit isn't taxed. Let's break it down. Imagine your business is about to make $5 million in profit. Instead of just letting that money sit in your account, you decide to reinvest it back into the business. Maybe by hiring more people, launching a new product, or expanding operations. By doing that, you don't pay taxes on that $5 million because it's being used to grow your business. This is how companies can grow quickly while keeping their tax bills low. And if you're the business owner, as the company grows, so does your net worth, with very little tax taking a chunk out of it. The idea is simple. If you don't need the money right now, put it back into something that can make you even more money. The rich know that their money works best when it's in motion, not sitting still. And by doing this, they get to keep their profits growing without paying extra taxes. 4. Own everything through your business. Here's another strategy the wealthy use to cut down on their taxes. They make sure everything they use is owned by their business. This might sound too good to be true, but it's actually a legal way to pay less in taxes. Let's say you need a new car for work. Instead of buying it yourself, you have your business buy it. Why? Because if the car is for business purposes, the money spent on it can be deducted from your business income, reducing the amount of taxes your business has to pay. Plus, you get to use it too. This principle applies to a lot of things. Technology like laptops, phones, and software used for business can be deducted. Travel expenses, including flights, hotels, and meals for business trips, are deductible. If you work from home, you can deduct things like your internet, office space, and supplies. Health insurance premiums and even business meals can be written off as well. The idea is simple. If you're going to use something for business, let the business pay for it. The more you can legally deduct, the less income you have to pay taxes on. This is a game changer because it can significantly reduce your tax bill while still giving you the things you need. 5. Claim your yacht as a second home. Here's a sneaky little trick the wealthy use to avoid paying higher taxes. They claim their yachts as second homes. It might sound wild, but it's completely legal. The government likes homeowners because it means people are investing in property, but they don't exactly cheer for the ultra-rich who like to show off their expensive toys. That's why there's always talk about taxing the rich more. So what do the rich do? They turn their yachts into second homes. As long as the yacht has a place to sleep, cook, and go to the bathroom, the IRS treats it like any other second home, meaning they get better tax rates. In practice, this means they get to use the yacht as a getaway spot, just like you might use a vacation home in a nice location. For example, they can sail to places like Mykonos in the summer and enjoy their yacht as if it were a second home, all while saving on taxes. And here's a fun fact. Motorhomes can be used the same way. If you've got a fancy RV with the right amenities, you can claim it as a second home too. But let's be honest. How often do you see ultra-wealthy people buying motorhomes? It's mostly yachts for them. 6. Use a trust to avoid estate taxes. Here's something the wealthy know that most people don't. Taxes don't stop when you die. If you're rich and you pass away, your heirs could face up to 45% in estate taxes on the wealth you leave behind. That's a huge chunk of your life's work. This tax is called the estate tax, and it can really eat into what gets passed on. Now let's break it down. If you're worth over $11.7 million, the U.S. considers you rich for estate tax purposes. If your estate is worth less than that, you either pay little or no estate tax at all. But $11.7 million might not sound like much when you think about the billions some people have today. And with inflation, it won't be long before more people hit the millionaire mark. So how do the wealthy dodge these taxes? They use something called a trust. Here's the trick. When you put your assets into a trust and certain rules are followed, those assets technically no longer belong to you. This means they're not part of your estate, they won't be taxed as part of your inheritance, but a trust does more than just save on taxes. It can also protect your heirs from blowing through your wealth too quickly. For example, if you left everything directly to your children, they could spend it all in no time. With a trust, you can set conditions like they only get access to the money when they turn 25. They get a portion if they graduate college or hit other milestones. In other words, you can still control your wealth even after you're gone, ensuring it's protected and used wisely for future generations. It's like giving your family the tools to manage money responsibly without handing them a blank check. 7. Gift money away. You can actually give money or assets to someone, and it won't be taxed. Sounds like a loophole, right? But there's a catch. You can only gift up to $15,000 per person without needing to report it to the IRS. If your gift is under that amount, it's considered non-taxable, and no one's the wiser. Now you might be thinking, okay, $15,000 is cool, but that's not exactly going to get you far if you want to buy something big like a luxury watch. But here's where it gets interesting. There's a lifetime limit you should know about. As of 2021, you can give away up to $1.7 million over your lifetime, all tax-free as long as each individual gift is under that $15,000 limit. So if you wanted to, you could give away a whole lot of Rolex watches, or whatever else you like, without the IRS batting an eye. It's a clever way the wealthy pass on wealth without paying taxes on it. While $115,000 might not sound like a game changer for the super rich, that lifetime $1.7 million gives you a lot of freedom to transfer wealth over time. It's basically like gifting with a free pass. 8. Hold it in privacy coins. Crypto is seriously shaking things up when it comes to storing and moving money. Imagine being able to fit $1 billion on a tiny USB stick, stick it in your pocket, and take it anywhere in the world, like flying to Singapore. Pretty wild, right? Now, while Bitcoin and Ethereum have become more popular, governments are tightening the rules. They're making sure that wallets are linked to individuals, so they can collect taxes and make sure everyone's paying their fair share. But here's something interesting. When you make a profit from selling crypto, in many places, you're only taxed at around 10%, which is much lower than the tax rate on other kinds of assets like stocks. But the game is changing again with privacy coins. These are types of cryptocurrency that let you transfer and store money totally anonymously. Unlike Bitcoin and Ethereum, privacy coins keep your transactions private, meaning no one else can see what you're doing. While privacy coins aren't illegal, the laws around them vary from place to place. The idea behind this is simple. Once you've earned your money legally, you should be free to move it around without anyone looking over your shoulder. It's like being able to make a private transaction, and it's something that's becoming more and more appealing for those who want to protect their financial privacy. 9. The art trade, a secret wealth strategy. Here's a little-known strategy the wealthy use. Buying art as an investment, and it's a game changer. When you buy a piece of art, it's considered an expense. And guess what? Some expenses can be deducted, which means you can lower your taxable income. But there's more to this than meets the eye. Let's break it down with an example. Imagine you earn $1 million in a year, and you decide to spend that entire amount on a painting. Now, since you spent the $1 million, there's no income left for the IRS to tax. You just reduced your taxable income to zero. Fast forward 3 years, and that same painting is now worth $6 million. An appraiser says it's worth that much. Instead of selling it for a profit, you donate the painting to a museum or to your own art foundation. Here's the kicker. By donating that painting, you just got a $6 million tax deduction. So assuming you still earn $1 million a year, you just saved $5 million in taxes. Pretty sweet, right? Now, what if you decided to sell the painting instead? You sell it for $6 million, making a $5 million profit. Normally, that would be taxed pretty heavily. But here's the trick. If you use the $6 million from the sale to buy even more art, you don't pay taxes on the $5 million profit. That's why art is such a powerful tool for the rich. It's not just about owning beautiful things. It's a clever way to keep more money in your pocket. This is exactly the kind of insider knowledge that can make a huge difference in your financial strategy. You're not going to hear this from just anyone. 10th, multiple nationalities with no fixed residence. Okay, this one sounds a bit out there, but hear me out. It's a clever strategy used by some of the wealthiest people in the world. The way taxes work is simple. You pay taxes where you live. But what if you don't actually live anywhere? Some super rich individuals take this to the next level by not having a permanent home base. Here's how it works. Instead of sticking to one country, they have properties all over the globe. So when they need to prove where they live, they just use an address from a place like Thailand or Bhutan, countries with different rules and no real info sharing between them. Some people even take it a step further and live on huge yachts, treating them like floating homes. One day they might be off the coast of Monaco, the next they're chilling in international waters. Now, while this might sound like a wild way to dodge taxes, it's not always the best move long-term. Yes, having multiple nationalities can give you perks, like access to different passports and benefits, but completely avoiding a fixed residence might cause more headaches down the line. Still, it's a tactic some of the richest people use to stay ahead in the game. 11th, charitable donations, a smart way to save on taxes. Here's a trick the rich use that's actually a win-win: charitable donations. The best part? Money you donate to charity doesn't get taxed. So what do the wealthy do? They create their own charitable foundations. Instead of handing over money to the government and hoping it gets spent well, they set up their own organization to direct the funds where they believe they'll make the most impact. This way, their money goes towards causes they care about, and they can ensure it's being used wisely. But wait, it gets even more interesting. These foundations need resources to run, like offices, staff, and even vehicles. And guess what? Those expenses are deductible. In fact, if you donate assets like land or cars to your own charity, that's still counted as a donation, and you get the tax benefit. Here's the kicker. Even though the charity now owns that car or property, as the head of the organization, you can still use it. On paper, the charity owns it, but it's available for you to use as needed. This creates a way for wealthy individuals to give back, reduce their tax burden, and still enjoy some of the benefits themselves. Smart, right? 12. Take equity instead of a salary. Here's a strategy the rich love. They don't get paid with regular salaries. They get paid in equity. This basically means they own a piece of the company. You might have heard Beyoncé sing about it, "Pay me in equity." And there's a good reason for that. First, equity, or stock, can grow in value over time. Instead of getting a fixed paycheck, they get shares that could be worth way more down the road if the company does well. Second, and this is key, equity isn't taxed until it's sold. So you could hold on to it and wait for it to increase in value before you decide to cash out. Take Elon Musk, for example. Instead of paying himself a regular salary, he earns stock based on how well Tesla performs. This is why, even though he's one of the wealthiest people in the world, he's not sitting on a mountain of cash. His wealth is tied up in equity. So when it comes to building massive wealth, the real lesson here is to think about ownership and equity. It's not always about how much you make right now, but about how much you own and how that can grow over time. 13. Borrow against your assets instead of taking cash. You might have heard people say that rich folks are cash poor, but still incredibly wealthy. That sounds confusing, right? Here's the trick. Rich people don't need to pull cash out of their assets because if they did, they'd have to pay taxes on it. Instead, they leave their money tied up in assets like stocks, properties, and other investments. But what happens when they actually need cash? Well, here's where it gets clever. Instead of selling off their stuff or taking a big payout, they use their assets to borrow money from a bank. Let's say someone owns a lot of property and stocks. They walk into the bank and say, "Look at all these valuable things I have. I don't need to sell them, but I do need cash right now. Can you give me a loan?" The bank looks at their assets and says, "Sure, here's a loan with low interest." The best part? Since it's a loan and not income, they don't pay taxes on it. They just have to pay it back over time, and they can keep their assets. It's a win-win. And this isn't just a one-time thing. If it's set up right, this kind of deal can keep working for years, especially if it's done through a company. So the takeaway here is, if you have valuable assets, you don't always need to pull cash from them. You can use them as leverage to get loans when you need cash without triggering tax bills. 14. Using bankruptcy as a strategic move. Filing for bankruptcy might sound like a nightmare, but for the rich, it can actually be a smart strategy when things go wrong. Let's break it down with a simple example. Imagine you're a lawyer making $250,000 a year. You've been successful, so you own a $1 million home and have $1 million saved up. Then you decide to invest big and buy a $10 million office building. You put down $1 million of your own money and borrow the other $9 million from the bank to complete the purchase. Now picture this. A global disaster hits, like a pandemic, and suddenly all the tenants in your building leave. The office building's value drops from $10 million to just $5 million. But you still owe the bank $9 million. Here's where it gets interesting. Because you own the building through a company, you can file for bankruptcy. The bank will take the office building, but they can't go after your personal home or your income. That's the beauty of bankruptcy laws. They protect you personally from losing everything. So, even though you technically lose the building, your personal finances are shielded. This means on paper, you might be broke, with your net worth even looking negative. But you're not really poor. You're still financially stable because your personal assets are safe. Also, if you had paid cash for the building, the loss could have been used as a tax deduction, which would lower your taxable income for the next few years, helping you catch up from the financial hit. So even in a tough situation, the rich have tools to protect themselves and minimize the impact. 15. Using depreciation to lower taxes. Let's talk about a clever little strategy called depreciation. Don't worry, it's not as complicated as it sounds. Basically, depreciation is when businesses can deduct the cost of something they buy, like a building, car, or machinery over time. Why? Because these things lose value as they're used, and businesses need to replace them eventually. Here's an example to make it clear. Let's say you buy a factory for $10 million. You plan to use it for 10 years, so the factory's value drops by $1 million each year. That's depreciation. Now, if your business makes less than $1 million in profit from selling stuff in that factory, guess what? You're not paying any taxes because the depreciation is enough to cover your income. This idea works for more than just factories. It can apply to things like equipment, cars, office buildings. By using depreciation this way, a business can legally lower its taxes year after year. So the more things you have that depreciate, the less profit you pay taxes on. The rich know that taxes are there to fund the government, but there's no rule saying you have to pay more than what you legally owe. Businesses that understand this strategy can grow faster, hire more people, improve their products. If more people understood how to make their money work this way, they'd be able to keep more of what they earn and avoid giving unnecessary amounts to the government. It's all about smart planning and knowing the rules. 16. Why taxes feel so high and what's really going on. Everyone wants to pay their fair share in taxes, right? The real issue isn't that people don't want to pay, it's how the government manages that money. Let's look at Switzerland as an example. People there don't mind paying high taxes because they see where the money goes. Education is free and top-notch, so everyone gets a great education without worrying about the cost. Healthcare is also free and high quality, meaning no one has to stress about paying for doctor visits or hospital bills. The environment is clean, and people enjoy living in a well-maintained place. In general, the people feel happy because they know their tax money is being put to good use. Now compare that to places where governments aren't as efficient. In some countries, taxes keep going up, but the money is wasted. Tax money is misused, like being spent on things that don't help regular citizens. Government officials get paid way too much while the services we actually need get ignored. Infrastructure, like roads and bridges, falls apart, even though taxes keep rising to cover the costs. That's what makes it frustrating for people. It feels like we're paying more and more, but not getting enough in return. It's like being asked to buy a ticket for a show that never happens. 17. Establish a family limited partnership, FLP. A family limited partnership is another strategy wealthy families use to manage and protect their wealth while reducing taxes. Here's how it works. A family business or investment property can be transferred into an FLP, where the parents are the general partners, controlling the assets, and the children are limited partners, holding shares. The beauty of this strategy lies in how it handles gifts and estate taxes. When transferring ownership interests to children, the family can apply a significant discount to the value of those shares due to the lack of control or liquidity. This is known as valuation discounting. This reduces the overall value of the assets being passed on, which in turn lowers the estate taxes owed upon the parent's death. Additionally, the FLP provides asset protection because the assets are held within a legal entity, making it harder for creditors to come after personal assets. This approach can also help families pass down wealth in a controlled way, as they retain the ability to set rules about distributions and decision-making within the partnership. It's a great way to manage and preserve generational wealth. 18. Utilize the 1031 exchange for real estate investments. Real estate is one of the wealthiest people's favorite asset classes because of its potential to generate consistent income and appreciation. However, there's a clever way the wealthy reduce taxes on their real estate gains. The 1031 exchange. Under IRS Section 1031, real estate investors can defer paying taxes on gains from the sale of a property by reinvesting those proceeds into a like-kind property. In simpler terms, when they sell an investment property, instead of paying capital gains tax, they roll those profits into purchasing another property of equal or greater value. This allows them to defer taxes indefinitely, sometimes for decades, essentially postponing them until they decide to sell without reinvesting. For those in the real estate game, this strategy is a huge win because it lets you continue to grow your portfolio without the immediate tax burden. Over time, the power of compounded growth from reinvesting can create massive wealth. How blockchain could change taxes forever. Imagine this. It's 2025, and technology is more advanced than ever. We've got all these tools at our fingertips, yet we still don't have control over where our tax dollars go. But what if we could? Picture an app where you could directly choose where your tax money is spent. Want more funding for your local school? Allocate some of your taxes there. Think the roads in your city need some work? You can choose to put some funds toward fixing them. Interested in supporting healthcare programs? You could pick that too. Of course, a portion of your taxes would still go to things like national defense and security, but most of the funds would be transparent, and you'd have the power to decide. This is where blockchain comes in. Thanks to smart contracts, you could automatically allocate a small percentage of your income to causes you care about, and everything would be fully transparent. No more wondering where your money's going. Right now, governments waste a lot of money just on bureaucracy and paperwork. We don't need more politicians. We need leaders who use technology to make things clearer and more efficient. With blockchain, you could finally have a say in how your money's used. The system is about to change. Big changes are coming to the way we pay taxes, and they're happening this decade. It's exciting because the old system is due for an overhaul, and things are about to get a lot more efficient and transparent. If you're on board with the idea of shaking up how governments manage taxes and want to be part of the change, drop in "Ready for Change" in the comments below. The future is wide open. It's your time to step up and make it happen. If you enjoyed this video, give it a thumbs up and share your thoughts in the comments. For more informative content on finance, entrepreneurship, and self-improvement, subscribe to our channel. We post new videos every other day to help you succeed in various aspects of life. Have a great day and see you in the next one.